You've got this jump in oil prices, Brent and WTI both trading up about 11, almost 12% right now, but not the type of extreme spike you might have seen in years past. So I ask you the question, in terms of the U.S. market, also in terms of the U.S. economy, this jump in prices, good or bad?
Well, I think that's up for debate. I guess the big thing I would focus on are the three cushions that we have against it. So one, inflation. So typically this could reverberate through inflation and cause it to move higher. Right now we have room. Inflation's at 1.4% overall. Number two, you mentioned the Federal Reserve. There is no way the Fed's going to not ease rates at the next meeting, no matter what. And central banks around the globe will look through this. And number three, the most important, the consumer in the U.S. has rebuilt their balance sheet, and they're still getting real wage increases over and above the rate of inflation. And so it won't factor through much to consumers unless it lasts for quite some time, which we don't expect it to. So those are the three things that I would focus on.
Okay. Brian, do you agree with that?
Yeah, we would, but, I caution people trying to make short-term inflation calls. We've been waiting for 37 years for inflation, and I don't think a one-week event with respect to what's happening in Saudi Arabia in terms of the oil patch will cause all of a sudden this great inflation day. But the key thing is the consumer, 70% of the U.S. economy. They've received a tax break over the last year or so with lower interest rates, continues to be very strong. I think what maybe people are missing is this whole notion of dollar-denominated assets, DDA, and that's what puts the dollar in effect. That's what actually puts our bonds still in effect and puts our stocks in effect. I still think this is going to be one of those situations where investors around the world will migrate back to North America, not just the U.S., but Canada as well. People talk about the energy patch in the United States. Well, Canada is exquisitely positioned to take a play with respect to what's happening in the global energy supply, especially considering the great companies that they have in Canada in terms of how they manage this trading range environment. So I think this is positive on a near-term basis for all of North America. But the stability of dollar-denominated assets is going to be the theme, we believe, for the next several months.
Brent, it sounds like you're saying that you expect the Fed to read this as a drag on growth, and that's why you expect a cut even more than before. What gives you confidence that that is the way that this particular incident gets interpreted, especially given the tepid reaction of the market today?
Well, I think the ECB action on last week actually sealed the Fed's deal, and they have to actually cut rates because everybody else around the globe is doing so, and our rates are so much higher. I also think any central bank right now does not want to have any impact on any recession, and so they will act with the utmost ease because inflation is still below 2%, and they are trying to create it. And so I think the Fed looks through this. And I guess one last thing I'd say is that Dudley editorial a couple of weeks ago probably perversely makes them actually have to cut because otherwise they'd be viewed as playing politics.
Brian, you mentioned North America. What specifically do you like in terms of asset classes here and also in terms of stocks? I mean, you see the move in the energy sector, for example, in the S&P. Is that a buy right now?
Well, it's a great question, and I believe the move into energy might be a little bit short-term, too short-term in the United States. And remember, there's been such a growth-dominated performance aspect to portfolios, Morgan, for a long time. We saw a nice move in value stocks the last week or so. I think much of that from a fundamental perspective is all about free cash flow. And if you're looking for free cash flow, financials and, oh, by the way, technology also give you free cash flow. So I think it's going to be less about value versus growth and more about companies that focus on free cash flow and overall earnings stability. Energy in Canada, we think, is much better positioned relative to energy in the United States. We're overweight communication services, energy, and financials in Canada. In the United States, we're overweight industrials, healthcare, communication services, tech, and, of course, financials. And we still think there's a lot of room to go with respect to financials, especially considering with yields heading lower and the Fed cutting interest rates. We think dividend growth and equity income is going to be an exceedingly important strategy for all investors for the next several months.